The Opendoor Technologies Inc. NASDAQ 1 Fernin stock is currently trading at $7.31 per share, reflecting a notable decline of minus 5.20% in today's intraday session. That's a sharp move down, and if you've been watching this stock, you know this kind of volatility is the norm, not the exception. The immediate drop today, even as the broader market shows mixed signals, creates a lot of tension, but here's the unexpected angle. The most recent and significant institutional filing activity is showing a highly contrasting picture, suggesting a massive split in professional opinion that the current price action just doesn't fully capture. We're seeing massive selling from some of the biggest names in asset management like BlackRock and Vanguard, who are significantly cutting their positions, but simultaneously we are seeing aggressive new long positions being established by names like Cube Research and Two Sigma Advisors. This isn't a market-wide retreat. It's a furious debate happening right now among institutional investors about Opendoor's solvency and its actual ability to thrive in a tough macro environment. A debate that is dramatically reflected in the wild daily swings this stock experiences. This polarization tells us that while the surface-level narrative is that Opendoor is struggling to find profitability in a high-interest rate world, the deeper reality is that a segment of smart money believes the company is on the cusp of an operational pivot that hasn't registered with the wider market. The common expectation for Opendoor Technologies stock is straightforward. It is a highly sensitive asset, a proxy for the housing market, particularly vulnerable to interest rate hikes. When the Fed signals a pause or a potential rate cut, the stock surges, as it did spectacularly, moving from its 52-week low of about 50 cents to almost $11 in a matter of months. And when rates are held high or show signs of moving higher, the stock is immediately punished, as we are seeing today. This whole narrative hinges on the iBuying model. Buying homes quickly with cash, making light repairs, and reselling them just as fast. The simple belief is that high interest rates cripple the final buyer's affordability, forcing Opendoor to hold inventory longer, which kills their razor-thin margins due to carrying costs and debt interest, ultimately leading to losses. The reality, however, is much more nuanced and challenging to that simple belief. While the macroeconomic pressure is undeniable, their most recent quarterly report showed revenue falling significantly year over year and an adjusted net loss of $90 million, the real story lies in what management is doing in response. They have recently initiated a substantial cost-cutting effort, focusing on reducing operational expenses and shifting their buying strategy to prioritize homes with faster turnarounds, a move that is less about sheer volume and more about margin discipline. This operational shift, often dubbed Opendoor 2.0 by the company, challenges the notion that the stock is merely a macro housing beta play. It forces us to ask, what if the company can decouple its destiny from the most volatile elements of the real estate cycle by becoming fundamentally more efficient and less reliant on high-volume transactional flow? Looking closely at the recent stock movement, the current downward intraday pressure is likely a continuation of the post-earnings reaction compounded by general negative sentiment following fresh commentary regarding the Federal Reserve's stance on rates. A rise in the 10-year Treasury yield, even a small one, is a direct headwind for a company so exposed to mortgage rates and debt financing. The high trading volume we're seeing today, even if it below the average, suggests a strong conviction behind the selling, likely short sellers taking advantage of the macro gloom to press their position, or perhaps institutional investors trimming their books after the massive run-up from the beginning of the year. This shows a market that is not trading on fundamental, consistent business growth yet, but on potential catalysts and counter-catalysts. This makes Opendoor a spectacular battleground stock, a magnet for speculation where retail investors often use platforms like Robinhood for its ease of trading volatile names, while the big players engage in high-frequency trading and sophisticated hedging strategies only accessible through platforms like Interactive Brokers. The stark contrast in recent institutional movements, large funds decreasing exposure while other large funds build new positions, means the risk and reward are both elevated, and the stock's short-term movement is less predictable than a simple correlation to the housing market might suggest. The narrative is that the losses are widening. The counter-narrative, which is what the buyers are betting on, is that the current expense structure is temporary, and the company's unique data advantage will soon allow it to price homes with the precision needed for consistent profitability. To understand the core business of Opendoor Technologies, we need to strip away the stock chart volatility. Opendoor is an iBuyer, a platform for buying and selling residential real estate, primarily offering cash offers to sellers for a quick, guaranteed sale. They then manage the property, conduct minor maintenance, and list it on the market. Their business model is entirely dependent on two things: pricing homes accurately to ensure they can buy low enough, and selling them fast enough to minimize holding costs, especially the interest on their debt used to finance the property inventory. This is a high-volume, low-margin business by design. When it works, the speed of transaction and the volume generate substantial revenue, a stark contrast to the slow, commission-heavy traditional real estate model where you'd use an individual brokerage. When the process slows down, as it has in the high-rate environment, the model breaks down because the carrying costs of debt start eating into or completely wiping out the gross profit on each home. Their success is direct function of their technology, the proprietary algorithms that price homes, and their operational efficiency. The current focus on Opendoor 2.0 is essentially a desperate but necessary attempt to prove that the tech side of their real estate technology company is powerful enough to overcome the real estate side's cyclical constraints. We need to consider the broader sector context. The traditional investment landscape has evolved, with platforms like Fidelity offering a wide range of options, from Fidelity mutual funds to Fidelity ETFs and sophisticated wealth management. In contrast, Opendoor is a high-growth, high-risk, pure play on digital disruption, far from the stability sought by clients of services like Schwab Intelligent Portfolios. The very concept of online investment has broadened from simply buying low-cost index funds to actively trading hyper-volatile names like Opendoor. This shift, facilitated by accessible online investing through investing sites like SoFi Invest and Robinhood stock trading, has directly contributed to the volatility of stocks like Opendoor, as rapid shifts in sentiment can generate massive retail trading volume quickly. The market is full of comparisons to other tech giants, such as Tesla stock and Apple stock, which redefined their respective industries. Opendoor aims to do the same for real estate, but the product, a physical, illiquid, expensive asset, is far more challenging than a car or a smartphone. The market is demanding evidence that their model can achieve the stability seen in other tech-enabled segments, even in the face of macro headwinds. Looking ahead, Opendoor's future outlook hinges almost entirely on two major factors: the trajectory of U.S. interest rates and the success of its internal cost-cutting and pricing strategy overhaul. The expectation is that rates will eventually fall. This is the simple bull case that has drawn in many retail investors. The reality is that management is guiding for increased home acquisitions in the near term, a risky move in a volatile market, but is explicitly aiming for a specific, healthier contribution margin and lower operating expenses as a percentage of revenue by the end of next year. The market will be laser-focused on whether they can hit these internal targets, which are designed to show a path to adjusted net income profitability. A key catalyst to watch for will be any major partnerships, especially around mortgages or title services, which could boost their ancillary services revenue, an area where margins are much higher than in the core home flipping business. Another major consideration is the ongoing volatility and potential for stock dilution. The recent announcement of a dividend in the form of tradable warrants is a complex move, on one hand rewarding shareholders and applying pressure to shorts, but on the other hand creating future dilution risk if those warrants are exercised. This kind of financial engineering signals an attempt to manipulate the sentiment and short-term price action, which is often a red flag that the operational fundamentals aren't yet strong enough to carry the weight. If you hold Opendoor stock or any similar high-risk, high-growth stock, you know that keeping an eye on every single market metric, from institutional holdings to the short interest, is a necessity. The principal risk remains the balance sheet. Opendoor's entire business relies on debt to finance its inventory of homes. If the homes sit too long, the cost of that debt, the interest expense, quickly becomes a significant drag on the entire enterprise. This is the structural flaw critics of the iBuying model often point to, arguing that it's not just a cyclical issue, but a fundamental one. The expectation is that they have enough liquidity to weather the storm. The reality is that their total debt-to-equity ratio is high, and a sustained period of high interest rates or a deeper-than-expected housing slowdown could force them to raise more capital at unfavorable terms, leading to further dilution. The opportunity, the true upside that the long-only institutions are betting on, is that if Opendoor successfully executes its pivot to higher efficiency and the housing market eventually turns in their favor, even moderately, the operating leverage of their platform could lead to profits growing much faster than revenue. This is the classic tech stock potential that has captivated investors. The difference between an investment in Opendoor and a position